The market is speaking in two voices at once. That's not confusion. That's coordination failure masquerading as balance. When signals contradict each other, most people freeze. They wait for clarity. They assume noise. They tell themselves, the system will resolve the contradiction on its own. That instinct is exactly what gets people trapped. Because mixed signals are not a bug. They are the signal. Look at the screen. Equity indices grinding higher as if gravity were optional. Credit spreads whispering caution, but not screaming. Volatility compressed like a spring held down by policy weight. At the same time, commodities refuse to behave. Energy doesn't collapse. Metals don't die. Shipping costs pulse instead of normalize. Inventories don't rebuild the way models say they should. Everything looks fine and wrong at the same time. That duality is not random. It's the mark of a system transitioning between regimes. Let's start with the event everyone read and promptly misunderstood. Central banks talk about data dependence while quietly extending emergency facilities that were supposed to be temporary. Exchanges update settlement language to allow alternative performance in extraordinary conditions. Regulators adjust capital rules not to reduce risk, but to decide who absorbs it when stress arrives. None of this is dramatic enough for headlines. It's administrative. It's boring. It's lethal if you ignore it. This is the bureaucratic horror phase, where nothing explodes, but everything changes. The rules are being rewritten mid-cycle because the old assumption's no longer clear. Liquidity is treated like oxygen, but oxygen only matters when you're suffocating. The calm narrative exists because the system is still breathing. Barely. Assisted. Here's why mixed signals matter. In a healthy market, signals converge. Prices, credit, volatility, and flows tell the same story. In a manipulated or stressed market, they diverge. Some are allowed to speak. Others are gagged. The result is a chorus singing in different keys. Equities are allowed to be optimistic because optimism stabilizes pensions, politics, and public mood. Credit markets are more honest because they deal with default, not dreams. Commodities are the most honest because they deal with physics. You can argue with analysts. You cannot argue with depletion rates. This is where geography tells the truth. New York and London are theaters of narrative. Shanghai is a warehouse with a pricing engine attached. One sells confidence. The other demands collateral. When Western paper markets say one thing and Eastern physical flows say another, believe the crates, not the contracts. The West's strength has always been abstraction, turning everything into a tradable claim. Futures on oil you never intend to receive. ETFs backed by assets you will never touch. Synthetic exposure layered on synthetic exposure until risk feels diluted. But dilution is not elimination. It's redistribution across time and counterparties. The East never forgot that markets are about goods moving through space. Energy burned, metal forged, food consumed. When stress builds, abstraction cracks first. This is why the signals are mixed. Paper says all clear. Physical says tight. The gap between those two statements is where the fracture lives. You see it in spreads that refuse to normalize, in lease rates that spike without explanation, in delivery times that lengthen while official inflation prints decline, in insiders shifting from price exposure to control exposure, storage, offtake agreements, long-term supply contracts. Things nobody on financial television explains because they don't fit into a 5-minute segment. The crowd doesn't see it because the crowd is trained to look at outcomes, not processes. They watch prices, not plumbing. They consume narratives designed to soothe, not to warn. Media blindness isn't censorship, it's selection. What gets airtime is what maintains engagement, not what challenges structural assumptions. And the most dangerous assumption of all is that contradictions resolve peacefully. They don't. They resolve through dominance. One signal wins, the others snap into alignment. That moment feels like revelation to the unprepared and inevitability to those who are watching constraints instead of charts. This is financial war, not in the cinematic sense, but in the logistical sense. Banks are fortified cities guarding balance sheets. Clearinghouses are bridges everyone must cross. Capital rules are rationing systems. And like every war, the early phase is quiet. Supplies move, positions are taken, casualties are hidden. Paper weapons are plentiful. Physical ammunition is not. The physical squeeze doesn't start with shortages on shelves. It starts with subtle refusals. Not available for immediate delivery. Premium applies. Minimum quantity increased. Each one individually ignorable. Together, a pattern. Paper can be printed. Silver cannot. Gold cannot. Energy cannot be conjured. Food cannot be willed into existence by policy statement. These are not ideological positions. They are thermodynamic ones. Basel III didn't happen to protect you. It happened to protect the system from its own leverage by redefining what counts as high-quality collateral. Read the footnotes. The devil lives there. Force majeure clauses aren't paranoia. They are legal acknowledgments that contracts are conditional on reality cooperating. Reality has stopped cooperating quietly. Mixed signals are what you get when reality pushes back, but the system isn't ready to admit it. So it hedges, it delays, it obfuscates, it keeps prices calm while adjusting rules behind the curtain. This is why calm is not comfort. Calm is a masking agent. Ask why liquidity evaporates without warning. Because liquidity is confidence with a bid, and confidence depends on shared belief. Mixed signals fracture shared belief. Some participants act, others hesitate. Depth thins. Volatility remains low until it doesn't. Then it explodes because there was nothing underneath. The crowd is always late because the crowd waits for permission. They want confirmation from the same structures that benefit from delay. By the time consensus shifts, the move is over and the cost is higher. Look at insider behavior, not what they say, what they do. Duration shortens. Optionality increases. Exposure shifts from return-seeking to risk-avoiding. Nobody announces it because announcements move markets. Silence is the tell. This is the paradox of mixed signals. They feel confusing to those seeking certainty. They are crystal clear to those mapping stress. Stress does not distribute evenly, it concentrates. First in commodities, then in credit, then in currencies. Equities are last because they are the most narrative-driven. By the time equities react, the damage is already done elsewhere. The West keeps telling itself that innovation will solve constraints. Sometimes it does, but innovation cannot accelerate geology. It cannot repeal energy density. It cannot replace trust once it's gone. The East understands this. That's why it accumulates quietly. Not to crash the system, but to survive its transitions. Control of physical flows is leverage in a world where paper claims outnumber real assets by orders of magnitude. This isn't about collapse tomorrow, it's about regime shift underway. The mixed signals are the seam between two worlds. One built on infinite liquidity assumptions, the other on finite resources and strategic control. The market is not confused, it is conflicted, torn between maintaining the illusion of continuity and adapting to constraint. That tension produces the noise you're hearing. If you're waiting for a clean signal, you will wait too long. Clean signals arrive after positioning windows close. They arrive when everyone agrees. Agreement is expensive. The real signal is discomfort. The sense that models no longer explain outcomes, that narratives feel forced, that explanations change weekly, that official calm feels rehearsed. That's not fear. That's cognition catching up to reality. Mixed signals mean the system is choosing who to save and who to sacrifice. Slowly, quietly. Through rule changes, not announcements. Through access, not prices. If you understand that, you stop asking, what's the market doing? And start asking, what is the system preparing for? Because systems don't prepare for nothing. They prepare for stress they cannot prevent. And when the signals finally align, they won't align gently. What happens next will feel nonlinear, even though the conditions leading to it were anything but. Systems rarely break where people are looking. They break where tension has been tolerated the longest. Mixed signals don't resolve by compromise. They resolve by dominance. One reality overwhelms the others. The first future people imagine is collapse. because collapse is cinematic and emotionally satisfying. Red screens, sirens, a single day where everything breaks and everyone suddenly understands. That almost never happens. What happens instead is a sequence of lurches: stress, relief; stress, denial; stress, rule change. Each lurch trains the crowd to believe the system can absorb anything, right up until it can't. The more likely near-term path is violent repricing without visible catastrophe. Certain assets explode upward not because the world is ending, but because access is being rationed. Others stagnate not because they are worthless, but because they are abundant in paper form. This creates the illusion of selectivity. See, the market is functioning. Some things go up, some go down. But underneath, it's not valuation driving outcomes, it's survivability. This is where the upside and downside scenarios blur into the same story. In a world of constraints, prices don't just reflect demand, they reflect urgency. When urgency replaces preference, price behavior becomes erratic. That's when things can rally and break at the same time, depending on where you're standing. The upside scenario is not a return to normal, it's a breakaway. A world where physical linked assets decouple violently from paper benchmarks. Where premiums become permanent features, not anomalies. Where owning something tangible feels like winning the lottery, not because it made you rich, but because it made you independent. The downside scenario is not universal ruin, it's selective suffocation. Some people are fine, others aren't. Some institutions glide through on exemptions and special access. Others hit legal walls they didn't know existed. The system doesn't fail everyone equally, it triages. This is why the psychology of the crowd matters more than the math. Crowds don't respond to data, they respond to perceived fairness and access. The moment people believe the game is rigged against them in real time, behavior changes instantly. FOMO in this phase doesn't look like meme stocks. It looks like hoarding. It looks like queues forming quietly, politely at first. It looks like people accepting higher prices without complaint because the alternative is exclusion. Panic doesn't begin with shouting. It begins with silence, with people no longer asking questions, just executing. And queues are the most honest market signal there is. Not queues for profits, queues for control. When people line up to secure something, they are revealing what they no longer trust the system to provide later. This is when the abstract concept of ownership becomes painfully concrete. Most people think they own things they merely have exposure to. Exposure is permission-based. Ownership is custody-based. That difference doesn't matter in stable times. It defines outcomes in unstable ones. Sovereignty is not a political slogan here. It's a logistical condition. It's the distance between you and what you depend on. The more layers, the more risk. The fewer intermediaries, the more freedom. Freedom isn't doing whatever you want. It's not being forced to do what you don't want under pressure. The system encourages dependence because dependence is efficient, until it isn't. Just-in-time works beautifully until timing breaks. Leverage works beautifully until volatility returns. Trust works beautifully until it's tested simultaneously. When that happens, philosophy stops being optional. You either understand what you truly own, or you learn under stress. This is where people make the mistake of overreacting. They try to predict exact outcomes. Dates, triggers, headlines. That's the wrong instinct. The right instinct is to reduce fragility across scenarios. To ask, in which futures am I trapped, and in which am I flexible? Flexibility is the only hedge that survives regime change. This doesn't mean abandoning markets. It means changing your relationship to them, from participant to observer-participant, from maximizing returns to minimizing forced decisions. The friendly advice here is simple but not easy. Slow down your assumptions. Speed up your preparation. Don't chase confirmation. Look for constraint. Don't wait for consensus. Consensus is always expensive. You don't need to be extreme. Extremes signal fear. You need to be deliberate. Deliberation signals understanding. Think in terms of redundancy. Not because you expect failure everywhere, but because redundancy turns failure into inconvenience instead of catastrophe. Systems with redundancy survive. Systems optimized to the edge don't. This is where the West and East mindsets diverge sharply. One worships efficiency, the other respects buffers. Buffers look wasteful until the moment they save you. The market has spent decades rewarding efficiency. It is about to relearn the value of slack. When the narrative flips, and it will flip fast. Calm will be replaced by urgency, urgency by rules, rules by resentment. That emotional arc is predictable because it's human. The people who suffer most are not the reckless. They're the complacent, the ones who outsourced responsibility to institutions without reading the fine print. The ones who believed access was a right, not a privilege, granted by systems under strain. You don't need to broadcast your preparations. Silence is strategic. The loudest voices are usually the least prepared. The best moves are boring, incremental, and invisible. This is not about survivalism. It's about dignity. About not being forced into bad choices by timing you didn't choose. About being able to say no when others cannot. The market will continue sending mixed signals right up until it doesn't. That's the nature of transitions. They feel confusing because they involve overlapping realities. The old world still functions, but no longer explains. The new world isn't dominant yet, but it already constrains. Once you see that, the noise becomes navigable. You stop asking which asset will perform best and start asking which decisions will preserve optionality. Which structures assume cooperation that may not exist. Which claims depend on legal language instead of physical availability. This is where calm becomes a tool instead of a trap. You use the absence of pressure to reposition quietly, to shorten dependencies, to build buffers, to trade a little efficiency for a lot of resilience. Because when pressure returns, and it always does, the market won't ask if you're ready. It will simply move. And it will move in favor of those who respected constraints when others chased comfort. This isn't a call to fear the future. It's a call to meet it on your feet instead of on your knees. To treat mixed signals not as confusion, but as early warning. The signal has already been sent. The rest is up to how you respond.